So with A, the question is saying that we should determine the appropriate net income based on the additional information that was being given. So when we go through the additional information, we realize that some items were not included, they were omitted, and some were not also recorded when they were determining the net income. So actually, the net income that was reported to us in the 2021 statement of financial position was 335,708 Ghana cedis. That was what was reported as the net income. And the additional information also made us realize that some of the information or the items were omitted or not recorded. So that means that the net income that was reported is not the correct amount. So we have to find for the correct amount or the appropriate net income. And this is how you are going to do it if you are calculating for the appropriate or the adjusted net income. You have to less the accrued insurance, which is 22,000 Ghana cedis. And you have to add the prepaid electricity, which is the 15,000 Ghana cedis. And this means that whenever that an expense is omitted, be less. And whenever that an income is not recorded, we add. So accrued insurance becomes an expense and prepaid electricity becomes an income, which is an asset and a liability. So the accrued insurance is a liability and the prepaid electricity is an asset. So this is how we treat them when they are being omitted or they are not being recorded. So let's get started and see how it's going to look like. So determine the appropriate net income. So you underline it nicely. So you introduce your cedi sign. Your cedi sign. So the first item that you are going to record is the reported net income. The one that it was mentioned in the statement of financial position, which was 33,507 and 8. Then you less your expense, which is accrued insurance. Accrued insurance. Which was 22,000. Let's do it on our calculator. So 335,708 minus 22030 is going to give us 313708. 313708. Then we add our prepaid electricity, which is an asset. Which is 15,000. So let's add 15,000 to this one. We are going to get 328708, which now becomes our net income. which now becomes our net income. So this is how you are going to find for your appropriate net income. So you first write the reported net income, which was given in the statement of financial position, which is 335,708. Then you less your accrued insurance, which is an expense. So anytime that an expense is being omitted from maybe your statement, your income statement, you have to add it, you have to less it, because it increase your net income. So you have to subtract it so that it will reduce it anytime that an expense is being omitted. And anytime that an asset is not being recorded in your net income statement or trading profit and loss account, you have to add it so that it will increase your net income. So one reduce it, one what increase it. So this is how you are going to record this additional information for you to get your actual net income. So the net income that we had was 328,708. So this is what we are going to use it for our profit or loss appropriation account. That's what you are going to use. And when we are going to our new balance sheet, which is the statement of financial position, this is what we are going to use. So this is all about the A. Okay, so let's quickly also do the B. So let's read the B again. Let's take the B again. So the B is saying that we should prepare the drawing and the capital account of Adam and Baba. Let's prepare the drawing and capital accounts of Adam and Baba. So let's start with the drawing account. The drawing account. So the drawing account, let's underline it. So that when you underline it, you are going to create a column for the partners. So let's write the particulars here. And here is Adam and Baba. Adam and Baba. So the CD sign. Never forget your CD sign when you are doing accounting. Always introduce them. So let's quickly go to the additional information and let's see the drawings that they made. So when you check the additional information, the drawing started from the second information that was provided. It said the beginning of the year balances on the drawing account were Adam 30,000 and Baba 25,700. So that was the drawing that they did. So we are going to name it the balance brought forward. So let's say balance brought forward. Adam was 30,000 and Baba was 25,700. So this is the actual drawing that they made. But when you further on with the reading, the additional information, we realize that during the year, cash amounting to 5,000 was taken by Baba for his personal use, but this was not recorded. So Baba was taking 5,000 Ghana cedis. During that year, Baba took 5,000 Ghana cedis for his personal use. So that becomes a drawing for Baba, another drawing for Baba. And when you move on to, it said a portion of the land valued at 15,700 was given to Adam to build his personal workshop. So this one also becomes drawing because that land that was given to Adam was not also given to Baba. So it was for only Adam. So whilst Baba was taking 5,000 Ghana cedis, Adam was also being given what? That piece of land, that wealth, 15,700. So that one too is a drawing for Adam. So we are going to also include those transactions. So cash. So cash drawing. And this one was for Baba, which is 5,000 Ghana cedis. And land. So also drawing, which amount to 15,700. So the total will give us, so total for Baba and total for Adam. So let's quickly add them. So 30,000 plus 15,700 will give us 45,700 Ghana cedis. So that is for Adam. And also Baba is 25,700 plus 5,000, which is also giving us 30,700. That one is also for Baba. So this where they are total drawings. They are total drawings. So Baba, within that year, withdrew 30,700 and Adam withdrew 45,700. So this is all about the drawing accounts for the two partners. And let's also deal with the capital accounts. So the capital account, so we are going to go through the same procedure. We have the particulars, and let's create accounts for the two partners, space for the two partners. So Adam and Baba, the cedi sign. So this one, since there was no permanent drawing, we are just actually going to introduce a capital that they introduce. That's what you are going to introduce. And the building, the land that was being given to Adam wasn't specific whether it is a capital. If it was a capital, you are supposed to subtract it from the Adam's capital that was introduced. That will give you the total, but it wasn't indicated. So what you are going to do is that the balance but forward as a die year. So that's their capital. So Adam introduced 400,000 and Baba introduced 300,000. So those were their capital. So Adam 400,000 and Baba 300,000. So total the same thing. So this one also becomes their capital account. Their capital account. So this is how we are going to go by the capital account and the drawing account. So this is the B. So we are done with the A and the B. And the C is actually telling us that we should prepare the profit and loss appropriation account and the statement of financial position. The statement of financial position after correcting the net income, and properly show, said we should also show how the partners' capital and drawing account should be presented. And the final statement, the financial position should also include the recognition of the Kubura's contribution to the partnership after the sharing of the corrected net income between Adam and Baba. So that's what you are going to do for the C.